The time for our personal finance feature with Warren Ingram, the co-founder at Galileo Capital. Look, if you're a private investor, you don't have the luxury of having big teams that do assessments on markets. So if there's a big downturn, you tend to feel the pain all on your own. Now, Warren, but are stock markets really stacked up against private investors, or, are there also benefits of being a private investor yourself?
I think it's it's something we all kind of face. We feel like the little guy against the massive Goliaths, and we see their buildings, and we see the big advertising that they do everywhere, all around the world, and we kind of feel a bit hopeless. But I guess there are advantages to being a private investor that maybe we don't always think about, and maybe they're not so obvious. So maybe just to get the bad news out the way, I think if you believe you can beat the big institutions in kind of day trading, or whether it's currencies or shares or derivatives or even cryptos, and you believe that you've got some kind of a trading edge, you've got a trading system or a trading algorithm that you've bought or that you've built, and you think that's going to help you. Sadly, you're only going to make money every now and then, and it's only going to be because you're lucky. The big institutions, they've got enormous amounts of money to trade, and what happens is that they're looking to make a tiny advantage. So where if it's me investing, I need to get a few percentage points return. I need to kind of grow my money by 5% here or there. Whereas what they need to do is they need to grow their money by 0.001 because they're trading R1 billion or $1 billion. And they're making huge amounts of money by moving markets in that way. So unfortunately, the little guy, you, me, and all the other private investors out there, we've got no way, no hope of trading against it. I'm sure people are listening saying that's nonsense. I've made money once, but they're not telling us about the 99 times they lost. So we don't
these
have
big institutions have money to lose, and if you're this little guy having a private investment, you don't have money to lose.
You don't, and equally, when you've got huge amounts of money like they do, what they can do is they can actually use that money to move markets a little bit every now and then. So they can actually use money to kind of take a loss, for example, and get an investment going down because they actually want the investment to go down. For example, they've shorted a share. So they'll actually start with loss-making trades to get the share going down, and then they make money. So they can do things like that. And, there is a very famous hedge fund manager who's very elderly, George Soros, and he's famous for taking on the British central bank. They speak about Soros breaking the pound. He can do that because he's making massive trades with huge amounts of money going against a country's central bank. I can't do that. My little piggy bank just, wouldn't even do anything against any kind of central bank. So I understand that. I think for my money, we can't move markets, and we can't predict markets, and we certainly can't trade them with any kind of consistency. So we've got to look in the ponds that, we've got to go and fish in the ponds that these big institutions don't. And for me, the big one is time. We've got something they don't have. We have time. We can dictate when we're going to buy. We can dictate how long we're going to hold investments. And most importantly, we can dictate when we want to sell. And they can't do that. They've got bosses that tell them they've got to make quarterly bonuses. They've got shareholders that are demanding returns every now and then. They've got these rankings because, if you look at the unit trust industry, for example, they love to brag about these awards that they win. And, they're number one ranked fund over the last 3 months. Well done. 3 months is nothing. But fund managers get fired when they're not doing well and they're not high up on the rankings. But if it's you or me, we don't care about rankings. What we care about is growing our money over long periods of time. If we're number 1 or number 5 or number 50 on some kind of, arbitrary ranking, it doesn't matter to us. What we want to do is we want to grow our money. So for you and me, I think our advantage is we can throw away these kind of arbitrary short-term kind of frameworks and benchmarks that are dominating institutions. We can grow our money because we can set goals for ourselves. and then go and make investment decisions based on that, rather than some boss telling us we better hit our numbers this month or this quarter or we fired.
Would it be a mistake then, Warren, if as a small private investor, you look to these bigger companies who have short-term goals in terms of the way they trade and try to mirror that? Would it be a better decision to play the long game instead of looking at what targets they have for the year?
I feel like we're always going to be on the wrong side of the story. I don't gamble and I don't go to the casino, but it feels to me like, the big institutions are the house at the casino, and on the other side of that, if we're trying to play in their trading game, we've always going to have those odds stacked against us, because
the house never loses.
The house never loses. If it loses a little bit of money, as you said, they can throw away a bit of money to make a lot more money. And I feel that's what trading and short-term investing is all about. And I know there are people out there that, are passionate about this, and private investors, and they're even kind of trading platforms and companies selling software that tell you that this is really easy. And I always kind of smile to myself, and I think, Matteo, if you had like an algorithm or piece of software that could make you money consistently, month after month, year after year, why on earth would you sell it to anybody else? You'd keep it to yourself.
You'd want to keep it to yourself, of course.
Yeah, you make money, right? So it's kind of garbage as far as I'm concerned. I think we need to kind of fish in different ponds out of this short-term stuff.
And as a private investor, then obviously you do your research on the market, on all the downturns that are happening and where you should keep your eggs invested. But, how do you then meander the space being alone? Because like I said earlier in the conversation, the bigger companies, the managers, the fund managers have bigger teams. They have a bigger budget. You on your own. And really, how do you get yourself out of being in a guessing game when it comes to investing?
I love your question, because you've got to take the guesswork out. So let's start with understanding that nobody, whether it's private investors or big institutions, nobody knows how markets move over short periods of time. Actually, nobody knows what the rand's going to do tomorrow. We can make an educated guess, but that's the best. It's a guess. So when you're making investment decisions, and there are so many variables, you think about things like weather patterns drive markets. Putin drives markets sometimes, and Saudi Arabia with their decisions around oil. All of those are massive factors that can move markets over short periods of time. What we also know is, if you buy shares, and whether you buy shares via an index or a unit trust or directly, when you buy enough different kinds of shares and you hold them for long enough, guess what? They go up over long periods of time. That's what the stock market does. So take the guesswork out by saying, firstly, when you make an investment decision and you commit money to your investments, you're not doing it for any kind of a period like 1 year or 2 years or 3 years or 4 years. You're doing it for 5 years and longer, because then all of a sudden guesswork and short-term movements has a much smaller impact on your money. What happens then is you're giving yourself a really good chance that your investments are going to do well. That they might not be the best, they might not be the top performing shares or unit trusts or exchange traded funds, but if you hold them long enough, and the bulk of your money is invested in shares, you will get capital growth over periods of 5 years and longer. And that's, for me, already one huge advantage that we have got and we should take advantage of is kind of time frames. I think the other one is we can set our own objectives. We can write our own rules, because what we want to do when we invest is we want to build money for a particular goal and for a particular time frame. And let's say, you're parents of young children and your kids are just born, and now you're saying, well, I might have to kind of pay for them to go to university. So that's, potentially 18 years away. That means you've got a really long time frame to commit money now. And if you do a little bit every now and then, and you keep building that money up, you've given it such a long time frame to build up and grow, that you're not worried about what it does over 1 or 2 or 3 years and what interest rates are doing. You've set your own rules. You've set your own time frame. And then you invest according to those rules and that time frame. You've created the game that suits you. You've become the house. And I think that's a huge advantage that we have got, because we're not dependent on everybody else then. And I think that's maybe my first big point, is set your rules, create your game, and don't worry too much about what everyone else is doing, because, they've got their own rules and their own kind of timeframes that are dictating what they do.
Well, that's Warren Ingram, co-founder of Galileo Capital, currently putting us at ease as private investors to say, look, don't look at the big guys, deal with your own small portfolio, but also play the long game. Thank you for joining us again for this particular conversation. We're talking personal finance with Warren Ingram, and today we're talking about the markets being stacked against private investors. Warren Ingram currently telling us that, look, you can look at your own investment and be in a good space, especially as you play the long game. Put all your eggs in different baskets, but also don't look at the big guys and get jealous. You are actually in a better position. And Warren, being your own boss, being your own investment advisor at times can be daunting. Where can we invest our money in terms of getting advice outside of ourselves to make sure that our investments are safe?
I think some of the other, really valuable tools that we've got as private investors is the range of investment products that are available to us are kind of expanding all the time. And one of my favorites will always be low cost index funds. The one thing about a low cost index fund is you can buy something that gives you exposure to kind of the whole value of the Johannesburg Stock Exchange, or the whole world market. There's an index called the MSCI All Country World Index. Try and say that after a few drinks, but the All Country World Index gives you exposure to all the shares in the world, that make up the bulk of the stock market value, and you can buy that, with a few $100, whether you do it monthly or quarterly or just with a lump sum, and it costs very little to buy those. And the thing about those indexes is that they tend to beat 8 out of the 10 professionally managed investment portfolios. So if you look at the unit trust world, the index does better than the bulk of the active funds, 8 out of 10 times. And that's an advantage that you've got as a private investor. The other option, of course, is to employ these institutions on your behalf. So you can go out there and say, you know what, I like the way that XYZ fund manager, manages money, and I'm going to make them work for me. I'm going to allocate my money to their unit trust or their fund, and I'm going to do it for a long period of time. You're out of the trading game now. You're making a long-term decision, and then you get them with all of their financial muscle and all their bright sparks that they've got working for them. You get them to start working for you. The trick there is, stay in the long game. Don't try and do this and say, okay, hang on, I've employed an institution now and they're going to manage my money for me, and I'm going to give them some money, and in 3 years' time it better have doubled. The truth is, the only way it will double in 3 years' time is if you're incredibly lucky. There's no skill involved. That's just dumb luck. And so don't rely on luck when you make this decision. Keep the rules stacked in your favor. Make sure that you do make those long-term decisions. And then I think maybe the other one is just be careful of kind of falling foul of the whole herd mentality. I think stock markets, whether it's private investors or big institutions, that they do really kind of get emotional about about investing. So you kind of see these periods where stock markets fall out of bed and everyone kind of, they're screaming headlines, blood on the streets, is this ever going to recover? And if that's the case, and you've got some money and you're listening to headlines like that or reading headlines like that, guess what? Start buying, because what's just happened is everyone's reacted super emotionally, and they're acting like they've only got 1 year to make investment decisions to make all the money, and you've got
it's the end 5, of the
10
world.
Or 18 years. Stay in and make money, and the truth is that often the market will give you these opportunities where you can buy when everyone else is panicking. And one of my favorite quotes from Warren Buffett is, be greedy when others are fearful, and equally be fearful when everyone else is greedy. So if we're sitting here and the headlines are about, stock markets are breaching all-time highs and economies are pumping and, everything is amazing all the time, it's probably a bit of a signal for you that the next crash is on its way, and maybe it's time to take some profits and, scale down your long-term views a little bit and be safe with some of your money. So I think it's about being not counter the trends necessarily, but don't get stuck in the hype. The hype is really lethal to your investment decisions.
But then, Warren, even as private investors, we're different. I mean, some will be happy to sit on their hands and make the money gradually, while others are still, they love risk, and, they can still split between the long game and risk. Is there space for that for private investors to say, look, between these next 6 to 12 months, I can take a risk, with a quarter maybe of my portfolio?
I think that you're kind of tiptoeing into the realm of luck again. I think
dangerous territory.
If you're in that, yeah, you're into the 1 day to 18-month time frame. You're in the casino of markets now. You're not in the long-term strategic decision making. You're now relying on luck. And one thing about markets is when you commit money to markets, it costs you to buy, it costs you to sell. So you're going to be paying brokerage fees and transaction costs to somebody. Whereas I believe, as I said, I don't go to the casinos, but I believe if you go and bet in the casinos, you might even get a free drink. So if you're going to rely on luck, maybe go to the casino. But to me, I don't want to be betting my money anywhere, whether it's in markets or casinos. And so if I've got a time frame of kind of, 1 day to 18 months, I'm putting that money in cash and I'm earning the best interest rate I can, but I'm certainly not investing it hoping to get a massive return. I think it's much more likely I make a massive loss.
As a private investor, then, how important is it to have your portfolio be under certain rules? So when you start investing, you don't just do it off the cuff. You have your own rules to say, look, mine is a long-term view on what I want to create in terms of wealth with this investment, and this is what I'm guaranteeing myself I'll keep to. And how do you actually get an accountability partner? Because you're a private investor. Bigger companies have people that look at reports and all sorts of financials, but as a person doing this alone, how do you account for some of the decisions you've made?
I think it's such a brilliant point, and I think maybe 2 or 3 answers. So the one is you can always start kind of an investment club with a few people that have interests the same as yours, where a few of you are kind of interested in investing. I'm not saying you need to put all your money together. That's a whole nother ball game with a whole different set of rules.
Yeah.
But you can sit down once a month and say, I've been looking at this, I've been doing some research on whatever the deal is. I'm thinking of making this decision. What do you think? And test that idea with 2 or 3 or, however many people that you trust. And collectively, you can kind of, I love stokvels. I think stokvels is kind of our power, like unique advantage in South Africa. But I'm not always sure we need to commit our money together. What we need to do is commit our research and our intellectual property together. And, 1 + 1 gets us to 3 if we do that. And I think that's what you could do. So that's one really good option. And it's free. The other option is go and pay an advisor to kind of give you a view, pay someone for an hour of their time and get them to have a look at what you're thinking about and what your strategy is, and get them to either, give you a critique and tell you the weak points and the strong points of your decision, and then walk away if that's what you want. And, the alternative, which I mentioned a bit earlier, is just allocate the money to a unit trust if you don't trust yourself to make these decisions consistently. I think those would probably be my 3 strategies.
And when you are a private investor starting out, what are some of the beginners products that you can look at, and even some of the indices that you can invest in as a beginner?
Well, that really horrendously long name is probably just to remind people. The MSCI All Country World Index is easily kind of a preferred index for me when I'm starting out. So I would take half the money that I want to allocate to shares, and I'd buy that, and the other half I would allocate to the JSE Top 40 or Top 50 index. There are actually 2 of them. And there are lots of exchange traded funds that will give you, an allocation to those indices. And so take the other half of your money and put it into those. That's one really good, avenue, very low cost. I guess, the other option is a general equity unit trust. Just make sure it's low cost. It's got a consistent investment philosophy. I'm not sure that if I'm a beginner investor that I'm going to go out and buy a selection of shares. I think that's probably a little bit risky, but those 2 options are, and there's nothing wrong with buying a general equity unit trust and an index. You can combine the two. So that's probably my suggestion when someone's starting out.
And Warren, then we have a question from one of our listeners saying, what's the best investment or saving strategy that I can consider for my daughter who's 5 years old? So I don't know what the target is in terms of the saving, but the daughter's still very young at 5 years old. What are some of the strategies they can apply here?
Please, please, please open up a tax-free savings account for your daughter. I think it's the gift that keeps on giving. It's the only free ride we get from SARS is this tax-free savings account. And just to explain it very quickly, I know it's called an account and it's a really silly name because actually you can buy an exchange traded fund, or a unit trust, or, I mean, if you really must, and I don't suggest it, you can put money into a fixed deposit or a bank account that's wrapped in this tax-free savings. But I think for a 5-year-old daughter, your time frame that I'm hoping is you're setting aside that money potentially because she might need to pay for university one day, or maybe you'll be able to cover a university and you want her to have enough money to put down a massive deposit on a house. Then your time frame is 5, 10, 15 years away, and so a combination of a world index and a top 40, top 50 index inside a tax-free savings account would be an incredible gift to give your daughter. And bearing in mind, you can allocate up to 36,000 Rand a year into a tax-free savings account for your daughter. It's quite a lot of money you can put aside for her. And by the time she's 20, she's probably going to be sitting on 500 to 500,000 to $1 million if you do that. And that's an incredible gift. So I would start early, tax-free savings, and just keep going. If you can't do the 3,000 or a month or 36,000 a year, just do what you can and tell friends and family to give a presence into her tax-free as a fantastic gift that will kind of reward her for many years to come.
Some great advice there from Warren Ingram, co-founder of Galileo Capital, giving us our personal finance feature today.